Please pay close attention. The next 30 seconds can make up for all your stock market losses this year and even save your retirement. You'll have a rare chance to hear from two Wall Street legends, Mark Chaikin and Joel Lippman. What Mark and Joel are going to share with you may make or break your retirement. A way to 5x your money even if this market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes, depending on which side you're on. Let's face it, the stock market's been a minefield this year, with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't safe anymore. Your money's losing value even as we speak, at a rate we haven't seen since the 1980s. They'll be giving you a financial lifeline that could erase this year's losses for you and trigger a wave of potential wealth that's so powerful it could save your retirement. For a sneak peek of Mark and Joel's big reveal, go to wealthcrisis2022.com. That's wealthcrisis2022.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is October 4th, 2022. We got a big show coming up for you. We're having a market rally. You may not know what that word means, but that means when stocks actually go up. Big rally to start the week. We're going to talk about why that's happening and if this rally has some legs. But more importantly, we're kicking off the fourth quarter. You know what that means, folks? I got your watch list of 6 stocks for the fourth quarter and beyond. Stocks I never talked about before. Coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It's October 4th, 2022. As I always say, it's a beautiful morning down here in South Florida. It really, really is. I can walk and get my tea and not sweat. And that's a really nice thing if you've ever lived in Florida. It's a nice feeling. So we got a big show coming up for you. As I mentioned, we have the market rallying right now. Again, we haven't seen much of a rally out of the market in quite some time, but we saw the Dow up several hundred points yesterday. This morning here, Tuesday morning, up over 600 points again. So we're looking for a 2-day gain as of right now, well over 1,000 points. And, you know, of course, the naysayers out there, which is a majority of people, will say, well, it's just a bear market rally. It's got no legs to it. We'll discuss that in a second, but let's take a look at the charts. I'm going to show you what's actually going on here and talk about what's really driving the buying that's been coming into the market here as of late. So let's take a look at the S&P 500. As you can see here on the right-hand side, those two big green candles there, those are the rally that we've seen. Keep in mind, on Friday, we closed at the lowest level since November of 2020. So nothing goes straight up and nothing goes straight down. So I don't take 2 days as being the end of this downtrend that we're in right now. And I think that we could see a pretty sizable short-term rally here. I don't know if this is the bottom. You're starting to hear some chatter from people talking about the bottom. Again, I'm not in the business of trying to pick the bottom. I'll try to pick a sweet spot when I feel the tide has turned. All that being said, folks, I talked about this the last couple of weeks. I do believe October could be setting up. October, maybe even early November, we have the midterm elections. That could be a little crazy for the markets, depending on what happens, because it's about a coin toss right now if the GOP comes back and takes more seats. So we'll see what happens there. So that is a bit of an outside wild card that a lot of people are talking about in the market. However, I've been saying I think October could be a time where we do find a bottom. You know, October is known historically in the stock market as the month of crashes and the month of bottoms. So could we have one more swing down that kind of wipes everybody out, that capitulation as they call it on Wall Street, and that leads to a bottom? Sure, that wouldn't surprise me. I think the odds of that are probably about 40%. I think another 40% is the fact that maybe we made a bottom here already. So it leaves 20% out there. That remaining 20% could be like a black swan, gray swan. Anything could happen. We could have some terrible news come out. Something happens with the war in Ukraine. Something happens with Credit Suisse. They're having some issues over there. The bank. Could it be the next Lehman? I don't think so. But anything could happen. That's the other 20%. So all that being said, here's kind of my strategy with the overall market before we jump into some stocks. My strategy right now, if you're in the market looking to put more money in the market, more specifically, is maybe you cautiously enter right now. You can put a little bit in. If we break down to a new low and we break through, maybe in a month or so, you put a little bit more money in. And then once we determine as a bottom and we have more of an uptrend, I'm okay paying a little bit higher, knowing that you put the next third in. So I think it kind of split up in tranches right now. I had an interesting phone call with a cousin of mine. We grew up next to each other, very close, same age. He's in the industry as well. And he called just to chat and catch up on the markets, what my thoughts were, get his thoughts. And very similar, it's right now, you start questioning your strategies right now, because we have one of the worst starts to the year ever for 60-40, going back literally a decade or a century. We have one of the worst starts for the bond market since the Civil War on pace for. We have one of the worst starts for just the stock market itself, the S&P, that we've seen since 1950. So you start questioning what you're doing. But I've been in this business for over 20 years, and I'll tell you this, folks. The moment you start questioning a strategy that's worked over the long term, over decades for me, you've lost your way. You can't start making emotional decisions based on these outside factors that are affecting the market. The bottom line is, the stock market is about companies. You're investing in a company. You're investing in a business. Regardless of what happens with, they find out who bombed the Nord Stream, let's say over there, the Russian pipeline. That spooked the markets for a bit. Regardless of what happens with that, do you think that's going to slow down a biotech company that's creating an next drug that's going to change the world? No, it's not. And that's how you have to look at things. Is there companies directly related to Nord Stream? Sure. But you have to, if you're looking big-term trends, you have to continue to stay focused on that. And I'm going to show you a chart here. This is from Ryan Dietrich, who's now over at CORZ Investment Research. And I just mentioned one of the worst starts of the year ever for the S&P 500. As a matter of fact, it's the third worst start of the year heading into September. So through the first first 9 months of the year, heading to the fourth quarter. S&P down 24.8% heading into the fourth quarter. You can see here, of the times that that's happened in the past, it's happened 10 other times. 9 out of 10, the next quarter, which would be the fourth quarter, was up. An average of 5%, median gain of 8%. The only year it was down was 2008. And of course, we know what happened 2008, 2009. That was Lehman Brothers. That was a great financial crisis. I don't see anything even remotely close to that. Much different. And we don't need to get into specifics, but much different. If you look out 1 year later, 80% time you're up, 70% average gain, median gain 25.5%. Again, 2008, really a wonky year. And 2001, it was down. Of course, we know what that was. That was a great tech bubble. Again, not in a similar situation, in my opinion, to do those two really huge recession / bear markets. So for me, again, there's so many stats out there, historical numbers that prove that we're close to a bottom, that we should be higher in a year from now. Again, I don't know where the bottom is, but we are pretty damn close. Now, why is the market rallying this week? Well, first of all, the very short-term indicators I talked about last week were all flashing extreme oversold short-term levels. We were due for a bounce. We had September down 9.3%. That's the worst decline for the S&P since worst monthly decline since March of 2020. And as I mentioned, we hit the lowest level since November of 2020. We had the Dow down almost 9%, the NASDAQ down 10.5%. And a lot of that had to do with, on Friday, we had a pretty ugly day on Friday, what's called the PCE. That's the Fed's inflation indicator that they use over the CPI. It was up 0.3% in August, 6.2% over the last year, more than anticipated, higher than what the analysts were expecting. That being said, it was a little bit lower than the 6.4% in the prior month. The core PCE was up 0.6%. That's when you take out energy and food. So that was pretty darn high, up 4.9% year over year. So again, that kind of caught people off guard, and the concerns are the Fed will be uber aggressive going forward. However, what we've seen in the last 2 days is the US dollar start to fall and yields starting to pull back a bit. Those two things really, to me, are setting up, that's kind of the opposite of what's going to happen. If the dollar comes down and yields come down, you will see stocks rally, especially the more aggressive small cap, what they consider aggressive tech companies rally more. So that's where we're sitting at right now. That's what we're seeing. My indications are showing that this rally probably has some legs for a couple of weeks. Again, we're in October. A lot of things can happen. We're only about a month away from the midterm elections. People aren't talking about that much. That will start being a conversation at some point. That could affect the markets here as well going forward. But the fun part is talking about individual stocks. As you know, I talk about this a lot. I have my watch list, and it's several hundred stocks. I take them off every week. I add some on, and it's just something I follow through. And I go through the charts usually every day, if not every other day, literally all several hundred, and just look at them, analyze them. I have something set up where all the news for all those companies come in. I scan it all the time, see what's going on. I keep up to date on them because those are the stocks that will be my next purchases. So I went through and I came up with 5 stocks and a little bonus stock, a 6th one, a very small one I'm going to throw in the end. And these are stocks that I don't have any exposure to. I don't own any of them myself. They're not listed in any of my newsletters right now. These are stocks that are literally on the watch list that I think for the fourth quarter and beyond. I'm not a 3-month investor. I'm not a 3-year investor. I look out 5, 10 years. So above and beyond the next 3 months, but they're setting up for what I think could be a good fourth quarter, especially if I'm right and those numbers are right from Dietrich, that it looks like the market's going to rally this quarter based on historical numbers. So all that being said, let's jump into the companies right now. And these are in no specific order at all. The first one I want to take a look at is Arcosa, symbols ACA. You take a look at a chart here. Stock's up big today, about 3.6%, up big in the last week and a half. And it's actually got a really nice chart. And it's up on the year with the S&P, as I just mentioned, down nearly 23% through the first 3 quarters. So Arcosa is a pretty interesting company because it doesn't necessarily fall in line with kind of the big innovation tech that I talk about a lot, but I like it. It's a $2.8 billion company. They produce infrastructure-related products and services. They have 3 segments. They have construction products, engineered structures, and transportation products. If you break down and look at where the money comes from, the revenue comes from, it's pretty much diverse, which is nice. It's not really relying on one over the other. Construction products sells the aggregates, and also does things for trenching and shoring, really truly infrastructure-related projects, which the government supposedly is going to be spending more money on that. We know the infrastructure here in the United States needs to be upgraded, so this can be a play off that. The transportation is mainly for inland waterways and rail transportation. They do a lot of stuff with barges. And again, that would be good for what's going forward with infrastructure. And then the engineered structures segment does a lot with energy and renewable energy as well. One of the divisions is Arcosa Wind Towers. It's a leading manufacturer of structural wind towers here in North America. It's also playing the upgrade of the power grid. We know the electrical grid here in the United States is in dire need of upgrade. So this would be a play on that. So engineered is the largest portion of revenue that it gets it from right as of 2021. And again, that's going to be everything from wind towers to telecom structures, the grid, electricity, transmission lines, somewhere that we need to have a lot of money invested. So it's sitting very well in a trend that is going to get money. If I look at the numbers, 2021 to just over $2 billion in sales. This year, looking for about 2.26. Next year, 2.4 billion. So you're not seeing huge growth. However, if you're looking for 2.26 billion, a company's only worth 2.8. You get a price of sales around 1.2. So value-wise, it's sitting very nicely. And then look at earnings per share. Last year, $1.93. This year, $2.32. Next year, $2.63. Puts a forward P ratio about 22.5. Again, pretty nice value considering that. And the bottom line is growing well. If you're not familiar with this company, it was actually spun off from Trinity Industries, which is symbol TRN, back in 2018. So you may not be familiar with it due to that. And Trinity, they spun off this and they kept the rail. It's a railroad company that they kept those services and products over in the other company. So that's number 1 is ACA, Arcosa. Number 2 is PRVA Health. Again, you may not have heard of this. This was a company that actually just went public in 2021. So it's a newer IPO. It's a $3.8 billion company, and it's all about healthcare IT. So let's take a look at this chart. Again, this is actually a great looking chart, folks. I'm going to zoom out a little bit because it's going to kind of show you a little bit more. Here's the IPO. Then obviously it started selling off and everything else, but it's worked its way back well. And this was a prior resistance level in the 30s, low 30, 32-ish, ran up and we're pulled back. We're sitting on support right now. So this is nice. I like the pullback we're seeing from a technical basis. It's looking very nice right here. And when it comes to healthcare, IT is one area that we really need to see continued upgrade in it. This company, I found when I was doing my research on it this weekend, they are the self-proclaimed Uber of managed care within the healthcare industry, obviously. It really, what it does is it partners with a lot of doctors, and what it provides them with that technology backbone. Me being the hypochondriac that I am, I've been to a lot of doctors' offices. And you go to some of them and it's old school, filling out 30 pieces of paper. They have files of paper, which is bananas to me. Then you have other ones where you basically fill everything out in line, you get there and you have a little iPad, boom, 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 it's done. But there's a lot of doctor offices that have not moved to that, basically to the 21st century yet. So they help with that. They help them with the financial knowledge of doing that. Also with insurance knowledge as well, which is extremely important because that's extremely confusing. And then what PRVA does is they collect their revenue on these services that they provide to the physician. So it's a great business model because not only does PRVA win because they make more money with more contracts, this is one of those win-win-win situations. And you know what that means? That means PRVA wins, the physicians win because now their business is streamlined. They could save a lot of time and overhead. And the third person win is the customer, which is the patient that goes in there. A much better experience. So this is a great business model. In 2020, they did 817 million in sales. Last year, 966. This year, looking for 1.3 up to 1.9 by 2024. So you're seeing some nice growth on the top line. Bottom line, they're expecting big growth down there too. 2021, 36 cents a share. This year, 14, up to about 80 cents a share in 2024. So healthcare IT is one of those niche sectors within healthcare, to me, that is often overlooked because it's a bit diverse, because you may have something like a teledoc, which is pure telehealth, and you have something like this where you don't think of this as exciting. However, as I just mentioned, it's one of those stocks that's in a win-win-win situation. You got to love that when all parties involved win, and that's what this provides. So this is a company again, and the chart is holding up well, and the stock's holding up well, and is actually up this year because of that, because of the services it provides, and the fact it's making money, and the fundamentals and the valuations are right in par with me. So that's number 2, PRVA Health, PRVA. Add that to your watch list. So these are all over the place. Infrastructure, healthcare IT, now sporting events and entertainment. Another company that went public, via a SPAC in the last couple of years. This is Vivid Seats. Symbol is SEAT, S-E-A-T. Smaller company, $634 million company. But what I like about this is not just the reopening trade, because people are back out there doing what they're doing, going to sporting events and concerts and things. But it's a leader in basically resale tickets. So if you want to buy a ticket to an event that's sold out, which is most good events you want to go to, whether it's a concert or a sporting event, unfortunately, there's other ones out there. There's SeatGeek, StubHub, all the other companies that are out there doing it right now, Ticketmaster. And, the thing is, they do charge stupid fees, and I get irritated every time I have to buy it and pay all the damn fees, because it's like, oh, that's not a bad price, overpaying. But then all the fees are in, it's like, holy smokes, that's a really bad price. But people like to support their sports teams like me. They like to go to concerts. People like to interact with other people. And that's a trend that we saw during COVID, because we saw how depressed people got and how being locked up just drove people crazy. We like to be out there. So here's a chart of Vivid Seats. As you can see, went public back here in October. That's when the SPAC was completed. And it's been drifting lower since then. But what I like on this chart, folks, is you can see in May, it made a bottom, tested it in June, tested it in July, came close to testing it in August, and again back here in September. But we're holding that level at $7, which is really important. We're starting to move up. Very short term, it's got to break above 850. If it does, it probably runs right to 10. But again, that's short term. I'm thinking big picture here. And when I look at Vivid Seats, the revenue in 2020, it's a newer company, it was only $35 million. Last year, 443. This year, looking for 559, up to 665 by 2024. And again, based off that, you're looking at price of sales of less than 1. Lost 9 cents last year. This year, looking to be profitable. We always look for that path of profitability. Looking to be profitable to the tune of 43 cents a share by 2024, to the tune of 74 cents a share. Based off that, you're looking at PE around 12. So you're looking at a price of sales below 1. You're looking at a PE ratio about 12 based off 2024 estimates. And that's right around the corner. And again, the trend of live entertainment, sports, concerts, whatever it may be, is something that's been around for a long time and it's not going anywhere. Sure, we can stream anything these days. We can watch anything we want from our phone or anywhere in the world, but there's something about being there live. And I think Vivid Seats, as much as I hate using them, I've used them in the past. It's a very fluid business model. This is a win-win, but it's not a win-win-win because us as the customers buying it, we have to pay up, but still it gives us the opportunity to go attend our events. So number 3 is Vivid Seats, symbol SEAT, SEAT. Excuse me. The next stock is a company that I've actually recommended in a past newsletter back in the day, and this is VRRM Mobility, symbol VRRM, $2.45 billion company. All right, folks, let's take a look at a chart of VRRM Mobility. Again, the symbol is VRRM. And again, I didn't pick these necessarily based off just technical analysis, but this is another stock that is actually up on the year, up today, up over 3%. As you can see, it's been really going sideways, but sideways in this market. Again, the market was down nearly 23% through the first 3 quarters, and this stock is actually up a little bit. That's a very good sign. So the chart looks great on it, so we have no problems with that. It had revenue last year of $550 million. This year looking for $735, big jump up. Not huge growth in the next couple of years, $835 million expected by 2024, but highly profitable. 24 cents a share last year, $1 this year, estimates for $1.32 in 2024. So I'm seeing nice bottom line growth, which means margins are getting better. So VRRM Mobility, they are a smart mobility company, and they provide services here in the US, Canada, Europe, Australia, so an international play. They have a parking division, which they provide the parking software. So, all the kind of things that you now see on a side of the road or in a parking garage, you don't need the attendants anymore. It provides both the software and the hardware. I like that because that means you're going to continue to have revenue coming in to keep that updated. It uses it for everywhere from parking operators, like I mentioned, cities, healthcare facilities, large universities. So it's something where that's not going anywhere. And we'll have autonomous vehicles at some point, but no time really soon, honestly. They also have those cameras, which we all hate, the road cameras, which take a picture of you if you go through a red light and send you a ticket. Those suck. However, you're seeing more and more around there. They also do the tolls where you go through. And they also have a fleet management division where they'll manage big fleets of either trucks or delivery trucks. Again, that's a really big thing because you ever go on a highway, there's trucks everywhere. Those fleets need to be managed. They help manage that with the software. So it's a software play and a hardware play, but I like the software aspect because that's something that's very scalable. Think about Microsoft in a grand scheme of things. They create the next version of Windows and they create it. They spend billions of dollars to create it, but then they get it out there and every new one that comes on is revenue, very similar to this. Software is created, they update it, but then the people who buy the software continue to update it as well. So this is a very under the radar company, very niche. But again, VRRM Mobility, VRRM, is stock number 4, I think, for the fourth quarter and beyond. You should add to the watch list. Next is a bigger company, but I wanted to put it on there because it's, again, a company that I recommended years ago through an old newsletter, and it's called ON Semiconductor, symbol ON. It's a $28 billion company, and this makes semiconductors and sensors for both the automotive and the industrial market. But when you think of automotive industrial, think of automotives here in a way of electric vehicles, autonomous vehicles. We are moving that direction. So there's going to be more sensors, more semiconductors needed for that. And ON as a leader in that area. The automotive end market accounted for about 34% of revenue last year. The industrial segment, about 27%. And the remaining business is just power solutions and stuff for computer peripherals, the end market of that. Very diverse, too. About 58% of its revenue came from Asia, excluding Japan. 70% in both the US and Europe, and 7% for Japan. So it's nice and diverse geographically, which is nice for a business like this. So let's take a look at the chart of ON Semiconductor. And again, boy, oh boy, doesn't that look pretty damn good? The semiconductors have gotten whooped this year, and this stock's only down a little bit. And it's a nice looking chart. And I'm going to show you the long-term chart here of ON Semiconductor. I mean, it started taking off here in 2020. And since that time, I mean, it's held up so much better than the semiconductor industry itself, which I love to see that. So we got the chart going for us with ON Semiconductor. And let's look at the numbers. In 2021, last year, 6.74 billion in sales. This year, looking for 8.25. Not growing much between then and 2024, only about 8.64. And a lot of the reason those estimates aren't higher is because people believe that the supply chain issues and everything going on with the auto industry right now may see very slow growth. I think a lot of that is priced into this, and I think we will see bigger growth than actually what a lot of people are predicting. And I think it's a nice value there. Earnings per share, $2.95 last year, looking for 5.12 this year, but then kind of flattening out in the next couple of years. Again, they're not predicting big growth. So we kind of have a bottom. We're not the predictions of growth for this are very low, single digits for the next couple of years. If it comes in anything above, they're even low double digits, you see the stock break out to a new all-time high very, very easily. They also have a key differentiator between itself and a lot of other semiconductors. They work with SiC, which is silicon carbide. And it's kind of the next iteration, silicon chips and moving to silicon carbide. They have higher level of efficiency. They have greater power density, which is needed for a lot of these electric vehicles and the future of a lot of industrial automation. And by the way, I should mention, in the industrial side, they deal a lot with automation. And again, huge trend. That's not going anywhere. Lower power loss, higher operating frequency, and they can take higher temperatures. All things that are needed for semiconductors and sensors during the roaring 2020s. So they meet a lot of the big picture stuff we're looking at. Has a great chart, has good numbers behind it. A company, if you're looking to be an individual stock picker in semiconductors, one of my favorites by far. So stock number 5 is ON Semiconductor. Symbol is ON, O-N. So I was going to stop there. However, I got a little bonus idea I was going to throw in there. Smaller company, and I was looking at Bitcoin today, getting close to 20,000 again. And this company is based off cryptocurrencies and blockchain. And this is CORZ Scientific, symbol CORZ. It's a $500 million company. It's really in two different segments. One is mining of cryptocurrencies, and the other one is equipment sales and housing. So this is a company that I think is one of the best miners out there right now. And at a $500 million company, revenue last year was $544 million. So a trailing price of sales of less than 1. This year, the estimates for $707 million, well below 1 price of sales. By 2024, the estimates for $1.21 billion. So below 0.5 price of sales based on 2024 estimates. And it's not profitable now, but as I always mention, a path to profitability. There's a good chance it could be profitable in 2023, if not by 2024, in my opinion. I'd love to see that. However, I will show you the chart, and you're going to say, what the hell are you doing, Matt? The chart is pretty damn ugly. So here's a chart right now. CORZ. It was at $15 last November. Now it's down at $1.58. It is up big today. It's up 15% today. I got a bit of an upgrade this morning. I didn't know that when I was doing the show, but I got a bit of an upgrade. But it's forming a bit of a double bottom here. Extremely risky down here. But this is the kind of stock that's, I want to call it a lottery ticket, but it's very similar. This could be back to $3, $4 before you know it, and it's easy a double from here. Keep in mind, if you don't like Bitcoin or you think Bitcoin's a joke or it's not going to go higher from here, you don't want to own this because this stock will not go higher without Bitcoin going higher. If Bitcoin moves higher and the cryptocurrency market moves higher, and we've been in what they call the crypto winter when stocks or cryptos get crushed. And maybe we start seeing the weather warm up and it's spring again and we see flowers in the crypto market. If that happens, this stock will go bananas to the upside. Huge risk to the downside. Huge risk. It's not profitable yet. So if we don't see it come close to profitability because Bitcoin and other cryptos don't move higher, huge downside to this, but huge upside. So this is not for most people at all. But I wanted to share as a bit of a bonus pick to go with my 5 stocks for the fourth quarter and beyond. So again, stock number 6, the bonus pick, is CORZ Scientific, symbol CORZ. So folks, that's where we stand right now. We have this new kind of 6-pack of stocks I want you to put on your watch list. Again, nothing here is a buy or sell recommendation. You have to do your own research. I always like to buy baskets of stocks. I don't like to pick individual stocks like that. It all comes down to your risk tolerance, your goals, your objectives. Every person is different. When I managed money for 17 years with my money management firm, every portfolio is different. People say, why is that, Mike? Because everybody who sits down with me is a little bit different. We're all snowflakes in life. And the same can be said for your portfolio. So please, you do your own research. And again, the three pillars of this show are to educate you on new stocks to put in your watch list, why I think they should be added to your watch list, which I just went through these 6. Number 2 is to, educate, have fun, which I hope you're having fun writing down the new stocks. And number 3, make money. That's the goal at the end of the day. I'm not going to share stocks with you I think aren't good, but I'm far from perfect. There's going to be a lot of stocks that I like that don't go up. It's just the nature of the business. It's kind of like baseball. And I will say my Phillies won last night, and they'll be in the playoffs for the first time since 2011. So congratulations to the Philadelphia Phillies. But when it comes to baseball, especially this day and age, if you hit the ball, not hit the ball, but if you get a hit 3 out of 10 times, your batting average is 300. You're probably in top 10 batting average, top 10 hitter in the league. And you're only getting a hit 3 out of 10 times. I'm not saying that's what our goal here is, but you have to realize getting hits 100% of the time, getting winners 100% of the time is not realistic. So that's why you want to have a diversified portfolio of stocks from all different types of trends, sectors, sizes, geographic regions, and build a nice, diverse portfolio for the long term. So before I wrap it, the S&P right now is up 2.6%. The rally continues. I'm liking what I'm seeing here, but again, I'm not sold on a 2-day rally. 2 days do not make a market. But I will say over the last 2 days, as of right now, the Dow's up over 1,300 points. We are seeing a bit of a bounce back, the highest level we've seen in about a week and a half. We'll see if this continues, and we'll keep you up to date, obviously, in the shows here every Tuesday and Thursday. Thursday's show will give you a bit of a preview. We have Scott Melker. He's the wolf of all streets, not Wall Street, wolf of all streets. Leans towards cryptos. We're going to talk about cryptos. We're going to talk about technology with him. We're going to talk about what's going on just in the overall economy and markets. And that's coming up on Thursday. It's going to be a great interview. The guy's got nearly 900,000 followers on Twitter. He is big. Travels around the world to speak. I'll be speaking with him in a few weeks at the Web3 Summit out in Vegas. Actually, in 1 week, I should say. Not even a few weeks. In 1 week, I'll be out there with Scott. So make sure you tune in. Scott Melker coming up on Thursday. Again, folks, thank you so much. I hope you were educated. I hope you had fun. And I hope you make some damn money out of this. Again, thank you so much for the support. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.